A standard bubble we defined over 20 years, perhaps 25 years ago, as a 2 sigma statistical event. It's just a measure of how much of an outlier you are. So you have a historical
deviation
series.
from trend.
Yeah, you have a price series of the S&P. You can calculate a trend. Statistics 101 is not difficult, and you can work out how far away from trend you are. And a 2 sigma is the kind of deviation that should occur every 44 years. And because we're a little wilder and less efficient than we should be, it occurs every 35 years. It's not bad.
We meaning human beings,
we being,
as a species.
As a species. Every 35 years. It was a little closer than I expected back then. But every 35 years feels about right. 1 a career, twice a lifetime. That feels like a pretty decent definition of a bubble. And a 3 sigma should occur every 100 years. Now we, as I like to say, we do crazy pretty well as a species. So they occur much more, 2 or 3 times more often than they should. They're out of kilter much more than 2 sigma. So 2 sigma, you can have some fairly standard bubbles. They give you a certain amount of pain, 30, 40, 50% pain. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had.
If the super bubble bursts, as you predict it will, what happens? What happens to the economy? What does history tell us?
Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money, they pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy. Then you're talking serious damage to the economy through the income effect. Because this time we have, as a multiple of family income, US housing suddenly is more overpriced than it was ever in the housing bubble of 2006 to 2008. And it got there this last year since we last spoke. The biggest increase, 20%, that the US housing market index has ever had has taken it to a new high. And they are, in the US, still much cheaper than Canada, Australia, New Zealand, London, Paris, etc. So that is a global event that could cause enormous pain. So we have a housing problem, we have a stock market bubble like 2000, we have overpriced commodities, oil is 88, and we have, of course, the lowest real rates in the history of man. It complicates it. And yes, it limits it. It probably does not remove it.
Because of inflation.
Yeah, and because of low rates. And now you don't have the tools that Greenspan had. Bernanke was more limited. He needed a lot of help from Treasury, from government spending. And what about now? Now you have a much higher ratio of debt to GDP. You have much more debt on the balance sheet of the Federal Reserve, and you have much lower rates. They will try, they will have some effect. There's some element of the put left. It is just heavily compromised, as you suggest.
How worried are you about inflation?
I haven't written about inflation for 20 years. When I did quarterly letters, I never featured inflation. I didn't think it was on the radar screen. It is now on the radar screen once again. It's not that inflation will go roaring back to 1972 or 1982. It's that it will always be part of the discussion from now on, in my opinion. Instead of forgetting about it, it will be spiking and irritating and falling back and then spiking again. It will be part of the scenery in the way it used to be in the second half of the 20th century. There's a lot about this economy, I think, that will be dragged back into the late 20th century. We've had a very, very abnormal honeymoon Goldilocks period for 20 years, which I think is ending. Let me put it this way. We're in the early stages of running out of raw materials. Of course, we live on a finite planet. There's only a certain amount of cheap oil, cheap nickel, cheap copper, and we're beginning to hit some of those boundaries. And we're going to have bottlenecks here, there, and everywhere. The food price index of the UN is about as high as it gets. Growing food is not getting easier. Climate change is coming with heavy floods, serious droughts, and higher temperatures. None of these make farming easier. So we're going to live in a world of bottlenecks and shortages and price spikes, and we have to get used to it and learn to manage our way around it.
So commodity prices that people perceive to be high right now may yet go quite a bit higher? I
think so. And it may well turn out that owning commodities or selected commodities will be something of an escape valve. Commodities have a long history of doing quite well when inflation picks up, for obvious reasons. And inflation is quite likely to pick up. Looking out into the future, it is pretty clear that we are running out of labor. Fertility rates have dropped like a stone. China is reeling from the shock of finding that it has 10.8 million babies last year. It's only the other year, 7 or 8 years ago, it had 20. And this means absolute certainty that the cohorts of 20-year-olds coming into the workforce will be smaller going forward. Everywhere in the developed world, we're below replacement in fertility.
You know the universe of professional investors well. Is there anyone out there whom you expect to navigate these waters well?
I think there's quite a few hedge funds that have a style of making 100 small bets, trading gas prices against diesel prices and Brent oil against Texas oil. They do 1,000 arcane little relationships. They're all independent of the market. If they do it well, they'll make a few percent, maybe even quite a few percent. And there will be some enormous dynamic moves in resources.
The Federal Reserve is confident that it can contain inflation with a series of incremental rate hikes. What do you think it'll take?
I think the Fed absolutely does not get the pain that's involved with a bubble breaking. You can see that in the history of the last 50 years. Greenspan encouraged the tech bubble. He bragged about the productivity gains from the internet that would last forever. Actually, productivity has declined slowly but surely since then. When it broke, it caused a lot of pain. Bernanke learned nothing. He encouraged the housing bubble. He denied its existence, even though it was a 3 sigma, 1 in a 100-year event that had never occurred in American history before. And what have we learned? We just went straight back into the game, overstimulating, pushing the rates down, down and down they have gone for 50 years. So they started at 16% on the long bond, and now the real return you would get is -2.
You've been a longtime critic of Alan Greenspan.
That's true.
You're a critic of Ben Bernanke, and I suppose by extension, Janet Yellen too. Do you have any confidence in the current chairman, Jay Powell?
No. No, he hasn't expressed any reservations about the Greenspan, Bernanke, Yellen, Powell policy of pushing rates down. They act as if a low rate is a panacea and comes with no downside. That is clearly nonsense. It's created, I think, the biggest evil in our society, and that is inequality. If you drive up the price of assets systematically, and it's bound to happen if you drive the rates down to negative territory, who do you make money for? You make money for the people with assets. Who owns the assets? The top 1% has 35% of all the assets. The top 10% have practically all the assets. What's the asset ownership of the bottom half? A rounding error, practically none. So you mark up the assets, and that's your contribution to society. What you're doing is pushing down on labor, pushing down on the bottom half, with no offset from increasing their assets, since they have none. And you're making the top 1% ineffably rich. And the data bears that out right down to the last 2 years, when the top 0.1% has doubled its wealth during COVID. And the bottom 50%, I can assure you, has not doubled its wealth. The dominance of a handful of firms has increased steadily in most subsets. And so profit margins have gone up, and the power of corporations has gone up, and they've been able to use more of their power in influencing government, and they have. There is a lot of regulatory capture where people from business tend to run the agencies that regulate the industries. So it's been a wonderful time to make money at the corporate system, and the share of GDP that goes to corporate profits has steadily risen, and the share going to labor has steadily fallen. This makes it a dreadful cousin with the asset class inflation that we've had. They both have two things in common. They make the rich better off, and they make the working class worse off. And that I think is the great poison at the moment in the American system. If we do not address rising inequality, we will be in real trouble. We are the least equal society, measurably, in the developed world. We have the least fluid economic mobility, for heaven's sake. You know, when I arrived in America in the 60s, it was a joke how rigid the UK was. The UK is now less rigid than the US. The number of people moving from the bottom quarter to the top quarter in a lifetime is half of what it is, say, in the Swedens of the world, in the US. We are the least mobile